Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome! We're diving right into the latest, most critical updates from the two giants of accounting standards, FASB and the IASB. You know, if you're operating in global finance, things are always changing. So let's get you up to speed.
You know, US GAAP and IFRS, they might have started from a similar place, but boy, are they evolving on separate paths. This constant stream of new guidance from both boards means the landscape is always shifting. Sometimes they line up, and other times they diverge sharply. So keeping track isn't just a good idea, it's absolutely essential for anyone managing global financial reporting.
So here's how we've broken it all down for you. We're looking at 4 key areas. First, how financial statements are presented. Second, the ever-evolving rules for financial instruments. Third, we'll get into the wild west of modern assets. And finally, we'll look at how to handle those really complex transactions.
All right, let's kick things off with the very foundation of it all, the financial statements themselves. Both boards have been incredibly busy here, completely overhauling presentation rules. And the result? Well, it's a set of diverging paths that's going to directly impact how companies report their performance.
Okay, so what's really striking here is that both boards are making huge moves with almost identical deadlines. You got the IASB bringing in IFRS 18, which is a total replacement for its main presentation standard. At the same time, FASB is getting super granular with expense disaggregation. They're moving in parallel, sure, but in totally different directions, and that's creating a brand new gap in disclosure.
Now, the big story with IFRS 18 is its sheer scope. I mean, this is not just a little tweak. It is a complete rewrite of IAS 1. The whole idea is to standardize the income statement with required categories and subtotals. But the real game changer? It's the new rule to disclose and reconcile management-defined performance measures, those MPMs. This is going to pull back the curtain on non-GAAP metrics like never before. It's a huge shift for investors.
Meanwhile, over in the FASB camp, the focus has really been on drilling down into the details. ASU 2024-3 is going to require much more granular info on expense line items. And this really just builds on ASU 2023-07, which expands segment reporting to include those significant segment-level expenses that are regularly given to the key decision-makers. Both of these updates are a direct answer to investor demands for a deeper look into a company's performance drivers.
Okay, let's shift gears. Our next section looks at how guidance for financial instruments is evolving. This is an area where we actually see some convergence, but also a ton of new guidance to deal with all these modern financial products.
So, looking at what's currently on their plates, you can see a few key themes popping up. The IASB is tackling some really modern issues like ESG-linked financial instruments, but they're also revisiting that age-old headache of separating debt from equity. At the same time, FASB is looking to overhaul hedge accounting to better line up the rules with what companies are actually doing to manage their risk.
You know, it's worth pointing out that FASB already made a major move toward convergence here with ASU 2020-6. They simplified the incredibly complex accounting for convertible instruments, and by adopting the if-converted method for diluted EPS, they brought US GAAP a whole lot closer to the IFRS approach. Honestly, that was a huge step in closing a pretty long-standing gap.
The IASB is also really pushing forward on these modern complexities. So on one hand, they're tweaking IFRS 9 to give clear guidance on assets with ESG-linked features. On the other hand, you've got the FISE project, that's financial instruments with characteristics of equity. And that's their big attempt to finally bring some clear principles to that notoriously gray area between liabilities and equity under IAS 32.
All right, let's get into what might be the most dynamic and challenging area for accountants right now, modern assets. Let's see how the boards are handling things like crypto assets and intangibles, like Goodwill.
And this slide right here highlights a massive point of divergence. FASB has acted, and they've acted decisively with ASU 2023-08. They created specific guidance that requires companies to measure certain crypto assets at fair value, with all the changes flowing right through net income. IFRS, in contrast, well, there's no dedicated standard. That forces people to try and apply existing standards like IAS 2 for inventories or IAS 38 for intangibles, which, as you can imagine, can lead to very, very different accounting outcomes.
This split on intangibles just keeps going when we look at Goodwill. The IASB is proposing a huge increase in disclosures for business combinations. They even want info on how an acquisition performs after the deal is done. If that goes through, the disclosure gap with US GAAP is going to become a chasm.
Meanwhile, FASB is tackling another key intangible, working to modernize its decades-old rules for capitalizing internal use software costs.
Okay, for our final section, let's dig into the latest guidance on some of the most complex transactions companies face. We're talking about things like joint ventures and business combinations.
Here you can really see FASB's rules-based approach in action. ASU 2023-05 gives super specific guidance for new joint ventures, requiring a fresh start at fair value. Simple as that. Similarly, ASU 2021-08 carves out a really important exception for revenue contracts you get in a business combination. Instead of fair value, you measure them under the revenue standard, ASC 606. This avoids the headache of revaluing contracts that already have a clear accounting model, which really helps with consistency.
And in a major development for private entities, the IASB has issued IFRS 19. Now, this is a total game changer for eligible subsidiaries. It lets them use the exact same recognition and measurement principles as full IFRS, which keeps everything consistent in a group, but with a much lighter disclosure load. It's a really practical solution that's aimed at cutting down the reporting burden without sacrificing quality.
So let's get practical for a minute. This timeline lays out exactly when all these major updates are going to hit. The main takeaway here is that the next 1 to 3 years, they are absolutely packed with critical deadlines. So if you haven't started planning for how to adopt these, well, the clock is officially ticking.
So where does this all leave us? Well, while we're seeing some targeted convergence in areas like convertible instruments, we're also seeing major new differences pop up in critical areas like crypto, Goodwill disclosures, and how the income statement is even presented. This really leaves us with a key question. As both boards try to tackle the complexities of the modern economy, are we heading toward a more harmonized global language of accounting, or are we charting a course toward new and maybe even more fundamental divisions?